Official interest rates in Australia are low at 75 basis points. And in fact, the market is even pricing in a further rate cut early next year. It can be quite difficult to conceptualise what do low, persistently low or negative interest rates actually mean for portfolios and individuals. So let's start with the individual. Firstly, savings, you get very, very little from your term deposit or from your savings in the bank. This is quite difficult for individuals who are net savers and particularly for retirees who require that interest rate to live off. The other distortion that it introduces into the market is that when rates are low, people have a tendency to overborrow and therefore overspend. This eventually becomes a problem when rates start to rise and they can no longer service that debt. The thing that worries me the most about persistently low or in fact negative interest rates is the capital market distortions that it leads to. It basically leads to a very inefficient allocation of capital. It actually makes managing a diversified portfolio quite challenging, and in particular probably the key implication is that it diminishes the role of bonds in portfolios. Now, that's not to say that we're suggesting you shouldn't hold bonds. However, the diversification benefit that you get is somewhat reduced. Because as yields have pushed lower, bond prices have pushed higher, and therefore the probability of capital loss actually increases. So what's important in managing a diversified portfolio is to find alternate sources of diversification. We've actually seen that start to play out quite a bit with the popularity of real assets in portfolios, so in particular property, infrastructure and gold. These are assets that are expected to return above cash and provide that diversification benefit. However, with all of the money pushing into this space, the real key concern is that these assets are becoming overvalued as well. When you actually see an increase in interest rates, the capital losses will be quite big in asset classes like infrastructure and property. However, because of their illiquid nature, it's difficult to actually simply get out of them quickly. The other major concern with low interest rates is the unnecessary risk-taking behaviour we've historically seen from investment professionals during these parts of the market cycle. And we experienced that in the lead up to the GFC. You would have heard the term hunt for yield. Because interest rates were low, people looking for higher yielding assets or higher returns started to push into more riskier asset classes, taking on more risk than they would have in normal market conditions. The issue with that is that when rates then eventually start to rise, these portfolios see substantial losses. And a lot of you will remember that some of the investments held in these portfolios completely dissolved after the GFC. The outlook for returns in this environment is actually quite low, predominantly because most assets are overvalued, and overvalued assets eventually mean revert back to their true valuation. So we're expecting losses in a lot of different markets, be it equity, bonds, property, etc. As a result, we think achieving a CPI plus return objective will be more difficult over the coming years. Avoiding losses will be particularly important in this environment.
Any advice in this video is general advice prepared by Morningstar without reference to your objectives, financial situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.